Our today lecture is related to valuation of stock or stock pricing, and or we can name it valuation of long-term securities. And what are the securities? These are the financial assets, one of the financial assets, or we can name it pricing or valuation of financial assets. As we know, we have explained in our last lecture that equity financing, there are two types of financing. One is equity financing, second one is debt financing. Why we make financing is done to support the long-term investment. If a firm wants to acquire a real asset, then firm needs funds, and funds can be raised either from the equity side or debt side, or it can be the mixture of debt and equity. If it's a mixture of debt and equity, then we can say that is capital structure. And today lecture deals with how we can find the fair price or actual worth of the stock, and what can be the tools, what can be techniques, and how we can evaluate the stock or one of the financial assets, that is equity financing. So equity financing is a sale of ownership. As we know that once firm issues the equity, and it means firm is going to sell its ownership for fundraising. Equity financing is the sale of ownership of the company for fundraising, and how we can say stock is an instrument of fundraising, and it's the claim of owners' financial assets on the real assets. So we have to understand this point. Why we are going for fundraising? Funds are being raised to finance the long-term investment. And what is long-term investment? That is the acquisition of real assets. And real assets, it means that is a long-term investment. And long-term investment is called capital budgeting. To meet the requirement of acquisition of real assets or long-term investment, we require funds, and funds can be generated from the right side of the accounting equation. Right side of the accounting equation, there are two components. One is debt, second one is equity, and in this slide we are talking about equity. And equity or stock is the financial assets of the firm. So financial assets are always claim on the real assets. We are used to listen a statement. Financial assets are the claim on real assets. How we can prove here? Then the real asset, to support the real assets, to meet the obligations or requirements to acquire the real assets, we are required funds, and funds can be raised from the from equity side or debt side. Now we are talking about the equity, and that is called stock, and stock is one of the financial assets. And here we can interlink our argument that stock is the instrument of fundraising, and it's the claim of owners' financial assets on the real assets of the company without any promise of dividend. Yes, without any promise of dividend, either firm pays or not pay the dividend. It's not the promise of firm. Firm can pay, or firm is not bound to pay the dividend to stockholders, because when we talk about the stock, there are two components. One is dividend, second one is market price per share. If we talk about debt, there are two parts. One is coupon, and second one is face value. Face value remains fixed over the life of bond, and there is a fixed coupon rate on the bond. Both are fixed. If they are fixed, then we can name that they are the non-arguable. But if we talk about the stock, there is dividend and market price. Both are changeable. They are not fixed. If they are not fixed, then we can name it arguable. So equity financing is all about the sale of ownership of the company for fundraising, and equity is one of the one of the financial assets, and it's the claim on real assets. Why it's claim? Because we are going to acquire the real assets without any promise of dividend. As we know, stock is arguable. I have explained that why it's arguable. Then there is subjectivity. If there is arguable, because either firm can pay or not pay the dividend. The other part is that's market price per share. What's market price per share? It's not fixed. It's changing. It's changeable, and every time, every moment, the market price per share can can be changed. So they are not fixed. If they are not fixed, then we can name it arguable. If they are arguable, then there is subjectivity. Subjectivity means which may vary. If there is subjectivity, there will be variation. What does it mean, the variation? Variation between fair price and market price per share. There is variation between actual value, market price per share, and estimated value or fair value. If there is variation, then we can name it. There will be uncertainty. Higher will be the uncertainty, then more will be the risk. So life of company, as we have discussed that in our previous lecture, there are three types of businesses. One is sole proprietorship, second is partnership, third is corporation. So sole proprietorship, there is single owner, and the life of company is linked with the life of owner. So if we talk about the partnership, it has also limited life. Then if we look at the company, it has unlimited life. It has unlimited life. Then stock is also issued by the company. Obviously, the life of stock will be unlimited. Life of stock will be unlimited, or we can name it company is ongoing process. Company is ongoing concern. If it's ongoing concern, then the stock will be obviously ongoing concern, because the stock is issued by the company, and company is having the unlimited life. So we can say the stock is also having the unlimited life. So if we look at this slide, there are two financial assets, bond and stocks. And bonds and stock, these are the fundraising instruments. And bond is undisputable. Why it's undisputable? Because its coupon is fixed on the face value, and the face value remains fixed over the life of bond, and which will remain fixed held till maturity, and its face value is given to the bondholder over the life of at the time of maturity. That's why if they are not changeable, we can name it undisputable. The other part is stock, that is called disputable. Disputable means they are arguable. Dividend not fixed. Market price per share, there is variation in the share price, that is called share price volatility, and they are not fixed. If they are not fixed, then we can name they are disputable. They are disputable. So disputable means arguable. If arguable, there is subjectivity. If subjectivity, there is variation. If there is variation, there is uncertainty. Then more will be the risk. They are undisputable means non-arguable. It means coupon and face value will remain fixed over the life of bond. So pricing of bond. Price. Look at this word. Just focus on this word. Price. Price means present value. Price means present value. Pricing is the present value of future cash flows which are discounted and appropriate rate of return. Discount rate, or we can name it interest rate. So pricing is the present value. Now keep in mind the time value of money concept. There are four components: present value, future value, time, and rate of return. So price is a present value, and there are two components. One is discounting, second one is compounding. When we talk about present value, that is discounting. Discounting means there is inverse relationship between present value and rate of return and time period. With the passage of time, if time is more, then the present value will be low. If the interest rate or rate of return is high, then the present value will be low. So we relate this concept with the pricing of bond. Price is the present value of future cash flows, which are discounted at at an appropriate rate of return. So here we can determine the price of bond. Keep in mind it's non-arguable. It's not disputable. So we can find the exact price of bond. So on bond there are two parts, two components. One is coupon, second one is face value. It's face value, not future value. It's face value. So we can find the present value or price of each cash flow on a different on an appropriate rate of return. So what is C1? That is coupon, first coupon amount, that is second time coupon amount, third time coupon amount, up to T. T means that is the life of bond. It can be 2 years, it can be 5 years, it can be 10 years. If the bond is 5 years, then the value of T will be 5. Then we can go up to T, up to 5. Then the next will be C3 divided by 1 plus KD raised power 3 plus C4 divided by 1 plus KD raised power 4 plus C5 divided by 1 plus KD raised power 5 plus face value discount. Here we will also calculate the present value of face value, present value of this cash flow. What is this cash flow? That is the future value. Why we are placing at the end? Because the face value is given to the bondholder at the time of maturity. What is time of maturity? That is T, over the life of bond. At the time of maturity, the face value will be given to the bondholder at the time of maturity. So as we know that in our time value of money, here we normally use IR or we can use I interest rate, or it can be also denoted by small r, but here we are talking about bond, price of bond. So price of bond, that bond is a debt, instrument of debt raising. So here, while firm issues the bond, there will be also cost of debt, which is denoted by KD, So overall, the calculation, we can calculate the price of bond, coupon of first period divided by 1 plus KD raised power 1, coupon of second time period divided by 1 plus KD raised power 2 up to NRT. When we talk about bond, there is cost of debt, because bond is an instrument of debt. If we talk about stock, there is cost of equity. That is cost of equity, which is denoted by KE. If we go for loan, bank loans, that is non-tradable. In the market, and these are the financial assets which are tradable, which are trading in the market. Bonds are tradable, and stocks are also tradable. So loans are the bank loans. Here we normally pay the cost of loan, that is interest rate, cost of loan. So while we're talking about the pricing of stock, as you know, stock is related to company, and company is ongoing concern. It means it has unlimited life. If it has unlimited life, then we can find the price of stock, which is denoted by PS, is equal to, on stock we normally use the dividend, that's PV. Use here D1 divided by 1 plus KE raised power 1, dividend D2 divided by 1 plus KE raised power 2, and up to its ongoing. If its life is unlimited, if it's not redeemable, it means it's irredeemable. If it's irredeemable, that is ongoing concern, ongoing stock, that is perpetuity. So we can calculate the price by this formula, and there are several models to calculate the stock price, and each model has its own properties, own assumptions, and their output, their overall calculation will be different to each other. That's why we name it arguable. So that's why we name it arguable, because they are not giving the same results, because market price per share, dividend, either from pay or not pay, it depends on the policy of firm. So that's why we name it arguable or disputable. If the life of stock is limited, means if resolved at maturity, means it is buyback by the firm. Buyback by the firm, that is called redeemable, means convert buyback by the firm limited life, then we can find the price of stock is equal to dividend d1 divided 1 plus k raised power 1 up to what's here, that is the market price per share at the time of maturity, at the time of redemption, market price per share divided by 1 plus cost of equity raised power t, and it's all that can be any value which is already given in the contract, either if it's redeemable. So types of stock, as I have explained in previous slide: irredeemable, unlimited life. Unlimited life of the stock, like common stock. If redeemable, that is the having the limited life, company will buy back the stock at the maturity. Buy back the stock at the maturity. I have explained in detail in the previous slide. There are different models, techniques of pricing and valuation of the stock. There are different models like relative models, cash-based models, dividend-based models, value-added models. Each model has its own characteristics, its own assumptions. If there are more than one model, obviously there will be more than one values of stock or pricing, and each model gives you different values. That's why we name it variation. And variation is subjectivity. Subjectivity is arguable. So each model has each category has sub-models, and the information can be extracted from books as well as market. So we explain every model in next slide. If we look at the relative model, there are 5 different approaches which are used under this umbrella. All information will be taken from market and books. For example, if price earning ratio, if we go for these are the traditional models. These are traditional models which are used, and here we take the information from market as well as books. If we look at the price to earning ratio. So price, what is price? That is market price per share. What is earning? That is EPS, earning per share. We can calculate, we can find the market overall fair price or fair value of the stock. Other model can be market to book ratio, market price to book ratio, market price per share divided by book value per share. We can calculate the market to book ratio under the head of relative model. Then there is another model, sales to price ratio. Sales of the company, it can be total sale of the company for a year, or it can be sales per share. So its formula is, if it's sales per share divided by market price per share. Sales to price ratio, it means sales is numerator, market price is denominator. If we look at the previous slides, market to book ratio, it means market is numerator, book ratio denominator. Price to earning ratio, it means price is numerator and earnings per share is denominator. If we talk about the overall sale of the company for a financial year, then total sale divided by market capital capitalization. How we can calculate the market capitalization? Market capitalization can be calculated market price per share multiplied by number of shares outstanding in the market. Then we can find the market capitalization. So the fourth model under the head of relative models, EBT to price ratio, earning before interest and tax of per share divided by market price per share. Then the next can be cash to price ratio. Cash dividend per share divided by market price per share. So the under the head of relative models, there are 5 different models which are used to calculate the fair price of the stock. And these models can help us either the stock is overvalued or undervalued in the market. If overvalued, then what will be our decision? If undervalued, and what will be our approach? Either we will buy or sell the stock. We will discuss this decision later. So the second umbrella is cash-based model. Cash-based model, there are 3 different approaches. Free cash flow approach, residual equity cash flow approach, and adjusted present value approach, means APV. These are the approaches which are used to calculate the share price under the head of cash-based models. The next is category is dividend-based model. There are also 3 different models: no growth model, constant growth model, supernormal growth model, and it can be named or phased growth model or 2-stage, 3-stage growth model. And we will explain these models in detail in our next lectures. Then the fourth category, value-added models. These are talking about the value. It can be economic value-added model, market value-added model, or cash value-added model. So there are 4 major categories while valuation the stock. Relative based model, which is having 5 subcategories. Then we have the free cash flow, cash based model, which is comprised by 3 different models. Then dividend based model and value based model. So each category is having 3 subcategories, and the first relative based model is having the 5 sub models to calculate the fair price or valuation of the stock. Relative model, it's an example. If we talk about the price earning ratio, I suppose this is the assumption based data, not the fact based data, not factual data. It's not the actual data. Suppose there are 4 companies in any industry. We're taking an example. This is not fact based data. There are 4 companies in an industry, company A, B, C, and D. Obviously they are having the market price, they are having the earning per share. So market price of company A is 40 and earning per share is 20. Then company B, MPS is 10 and EPS is 8. Company C, market price per share is 100 and earning per share is 60. And company D is having 5 and 3 is the EPS. First of all, we can find the price to earning ratio. Because we are talking about price earning ratio model. Price to earning ratio, it's very simple. The formula is given. We can calculate the price earning ratio. The price earning ratio is market price divided by EPS. So market price of company A is 40 and the earning per share is 20. Overall, the ratio is 2. Company B, 10 over 8, market price per share is 10 and EPS is 8. So its answer is 1.25. And same for company C, market price divided by earning per share. The overall ratio is 1.67. Then the company D, market price divided by earning per share. The overall value is 1.67. Then how we can calculate the fair price? If we look at here, the fair price can be calculated. First, we calculate the price earning ratio of the industry, not the single company, because in previous slide we have calculated the price earning ratio of individual company, individual firm in the industry. I suppose there are four firms. If we look at the four firms, so how we can calculate sum of price earning ratio? It's sum, not dollar, it's sum. Summation, price earning ratio divided by number of companies. Price earning ratio summation is 6.59, and there are four companies in the example, so its value is 1.65. Its value is 1.65. If there is variation or subjectivity, then there will be difference in the between the actual and estimated fair price. How we can find the fair price? Price to earning ratio of the industry multiplied by earning per share. Then here we can find the calculate the fair price of a stock of each company. The outcome will be either it can be overvalued, either it can be undervalued. Excuse me. If it's overvalued, if fair price, this calculated price, fair price here is less than market price, it means in market it's over traded, but its the actual value is less than the market price. If fair price is less than market price, then we can name it it's overvalued. If its market price, fair price is greater than market price, then we can name it undervalued. Then what will be our decision? We can check here. How we can find the fair price? Earning per share, price to earning ratio of the industry. How we can calculate the earning per share of the industry? Sum of these EPS divided by number of companies. There are four companies in this example. So the overall, the average is 1.65 multiplied by EPS. So the sum is, this, after simplifying, the value is, fair price is 33 for company A. The company B, fair price is EPS of the industry and price earning ratio of the industry multiplied by EPS of firm B. Its value is 13.2. Then price to earning ratio of the industry, that is 1.65 multiplied by EPS of firm C. So the value fair price is 99, and same for the firm D. What is our decision? As I have stated, it's fair price, it's market price. Market price is 40, but the actual worth is 33. But the actual value is 33. Market price is 40, actual value is 33. So in the market it's overvalued. Its worth is 33, but in the market it's overvalued. If it's overvalued, then we will sell. Consider yourself as an investor. Then you will sell because it's overvalued. In actually, it's having the worth of $33 or rupees, whatever the unit you are using, currency unit you are using. In market, it's 40, but the fair, actual, estimated, calculated is the worth is 33. It means it's overvalued. If it's overvalued, then you must have to sell that security. Okay? Because its worth is 33. Market is overvalued. Look at the second one. Market price is 10. Traded in the market at 10, but its worth is 13.2. It means it has potential to earn the profit. Then if you can buy that share, buy the shares of stock of company B. Look at C. Market price, that is 100, but the fair is 99. But there is a nominal difference. And again we can talk about the decision that is overvalued. You can sell. If we look at here, the market price is 5 and the actual is fair is 4.95, that is also overvalued, you can sell. There is nominal difference. It's why we use these models if you want to go for the portfolio of different securities. And what is portfolio? Combination of more than one securities. And portfolio, it diversify your risk. Okay, then you can buy or sell, then you can design your portfolio of investment. Hope it will be clear. And if we talk about the sales to price ratio, here sales, well, same example, suppose we have three companies, three firms in the industry, the total sale of the year is 100, 10,000, 5,000, 8,000. It's example, data is assumed, not real data. Number of shares of company 1 are 50, outstanding shares in the market, there are 50 number of shares. Here there are company 2 is having 20 shares, company 3 is having 10 shares. This is example, not the actual data. First of all, we can find the market, there is also market price per share. The MPS of company 1 is $40, or company 2 is 30, company 3 is 20. Then we can find the sales per share. How we can find the sales per share? As I have explained before, that total sale divided by number of shares outstanding. The sale per share is 20 of company 1. The sales per share of company 2 is total sale divided by shares outstanding, it's 250. The sales per share of company 3 is total sale divided by shares outstanding in the market is equal to 80. What approach we are using? Sales to price ratio. Do we have market price per share? Do we have sales per share? Sales per share. So the sales per share, we can find the sales to price ratio. Sales to price ratio. What is sales per share? 200. Market price per share? 40. The overall answer is sales to price ratio is 5. Then we can find for company 2, sales per share is 250. Market price per share is 30. The overall answer is 8.3. Then we can talk about the sales per share of company 3 divided by market price per share of company 3. That is, the overall sales to price ratio is 40. And how we can find the fair price? We can find the fair price. First of all, we have to find the sales to price ratio of the industry. That is the sum of sales price ratio divided by number of companies. Same as the previous calculation. So sum of sales to price ratio, 53.3 divided by number of companies. In this case, there are 3. 17.5 is the sales to price ratio of the industry. So fair price can be determined sales per share divided by sales to price ratio of the industry. Sales per share divided by sales to price ratio of the industry. So sales per share we have calculated here of company 1, 200 divided by what is the sales to price ratio of the industry, not individual. Okay, 200 divided by 17.8, it's 11.23. Same for 250 sales per share divided by sales to price ratio of the industry, that is 17.8. The sum is the overall value is ratio is 14.04. Same for the firm 3 or company 3, sales per share of company 3, that is 800, and the industry price to earning sales to price ratio is 17.8, it's 44.94. How we can make the decision? Fair price is simply compared with market price. If market price is more, fair price is less, it means it's overvalued. If it's overvalued, simply you will sell the stock. Here, if you look at the market price is 30, fair is 14.04, it's overvalued. you can sell that security. Then if we look at the company 3, market prices 20, but the fair value is 44, almost 45, so it's undervalued in the market. Then you can buy the share. So this is about total lecture. The rest I will explain in my tomorrow lecture.